Welcome to TheoTRADE. This is Don Kaufman, September 12th, 2025. Minutes stand between me and this weekend with the S&P futures, well, quite literally massively unchanged. NASDAQ's up about 100 handles, but what's really interesting, you've got the Dow and the Russell down. In fact, when you look at the advanced decline line, what an absolute slop fest if you're not seeing it on the screen. The advanced decline line has been decisively negative in the S&P 100 throughout the course of the trading session. But does anything matter anymore but tech? All right, fair enough. I'll do a quick review of this past week in trade, but what we really want to do here on this weekend update is discuss what's coming. It's the triple witch and a multi-trillion-dollar expiration. Could get a little bit wild out there. There's going to be a lot of positioning. I'm going to explain that here momentarily. Let's start with kind of a brief breakdown of some of the price action that we've seen this past week in trade or lack thereof. So there's no question that the marketplace is finishing this week higher. Not here to debate that at all. The S&Ps are about 90 points higher on the week. That's right now. Obviously, we have 10 minutes left to into the bell, but we're about 90 points higher. Really, all that has occurred this week. We didn't really have any trade activity on Monday, Tuesday. Wednesday got a little bit of a bid under us. Thursday, very, very quiet. And here we are on Friday. I mean, if you look at Friday's trade, between Thursday and Friday, Thursday, there was a little bit of a bid in the morning. It has been 10 handles of S&P range. And, this is when boring's okay. Like boring's okay. There's a lot of movement in individual equity products, but what's disconcerting at this point is the S&Ps feel like they can't get out of their own way, but at the exact same time, and I think a lot of people are probably missing this, and yeah, pointing this out in the S&Ps, but there was like almost record-breaking contract size in options traded yesterday, which you're like, well, what was yesterday? So it's like a Thursday. There was 9 million option contracts traded yesterday. Absolutely staggering size, once again, for a marketplace that did not move. So it made me start to look around a little bit at like, well, what's going on over here? Like, why is there so much size? And a lot of it, unequivocally, like you look at stuff like Tesla, and Tesla alone today is good for 6 million contracts. And that, of course, that it rivals like spiders, which is insane. Between Tesla and the spiders, literally those two underlyings and those two underlyings alone, it's over 12 million option contracts. Throw the SPX in there, the mother of all products, okay, you're good for another 3 million. You just got to recognize like the concentration in liquidity right now. And, I've said this like a year ago and said it 6 months ago, and I'm going to say it again right now. It has never been greater. And what I mean by the concentration in liquidity has never been greater, there has never been a time in markets, okay, where we have actually focused more on just a handful of products. You just do some quick math here. So, the spiders got 6 million, Tesla's got 6 million, so you're up to 12 million, right? Then you add in the SPX. All right, you're already over 15 million. Have NVIDIA, which is good for another 2 million. You realize we're at a handful of products. And then anything that's off the beaten path, like anything that isn't like in play right now, is good for absolutely nothing. Like this is the entire energy sector. I traded 36,000 contracts like Walmart. Walmart's got a pretty good bid under it. Okay, there you go. Did 100,000 contracts. But you look at stuff just off the beaten path over here, and things are just, There's nothing like Caterpillar, 9,000 contracts. Okay, it's wild right now because what we're doing is we're seeing like all the firepower in the marketplace. When I talk about firepower, we're talking about hedge funds, proprietary trading firms, market making firms. All that firepower is being targeted literally in 5 to 10 different products, including the spiders, the SPX, even stuff like VIX. Okay, VIX is doing almost 1 million contracts today, which is it's decent. It's actually 2.5 times versus the previous 5 trading sessions. There's actually some decent volume in there as well. So look, with this kind of concentration and liquidity, okay, it's really going to matter in triple witching. I'll come back to that in just a moment. So this week of trade came down to exclusively just the upper edge of the SPX expected move. One thing that I said in last weekend's video was like, anticipate us to head to the upper end or lower edge of the expected move, do a little dance, make a little love, get down tonight. Look, we are officially outside the upper edge of the expected move, but people, okay, this one it's marginal. I mean, when you're in a $6,500 product, okay, and you close outside of a line that I drew by $20, it's marginal. It's a little bit of like a margin of error, if you will, but it counts. In my book, if you're outside the expected move by more than about 10 to $15, okay, I'll highlight this as outside the expected move. And again, that expected move was just shy of $86, okay, in the week that we just passed through. Now, when you start looking at individual, like products and sectors this last week. So the financials had a pretty good week. Their upper edge of the expected move. The energy sector had a pretty good week. It's upper edge of the expected move. But the reality, it all came down to a handful of tech stocks. Today, take a look at Tesla, okay? A huge break, huge gamma squeeze, if you will. NVIDIA, okay? Absolutely flying on news earlier this week. Breaks outside of its expected move. Okay, Meta did nothing this week, but that didn't hurt the marketplace. It just didn't help it. Google, upper edge of the expected move. Amazon, okay, Amazon in terms of tech is pretty much your weakest. It even hit the lower edge of the expected move. Microsoft flying high outside the upper edge of the expected move. Okay, Apple, after getting absolutely decimated, okay, returned to the lower edge of its expected move. Again, but they pale in comparison. Like these pale in comparison to some of the other moves that we're seeing on here. And Broadcom now is even a player in this category. As if you miss this, Broadcom now is approaching almost the $2 trillion mark. So Apple doesn't look so big anymore now, does it? The point that I'm making is it's a bit of a slop fest, okay? But there was enough mega market capitalization to drive us higher, okay? And predicated on what? Nothing, just order flow, okay? The market right now is trading. Like I know you guys could spend a lot of time on technicals and a lot of time on levels. The market though right now is kind of trading by the seat of its pants. There's not a lot of clarity, not a lot of visibility right now. You have the S&Ps, okay, legit closing at or near their all-time high. You have the NASDAQ literally at its all-time high. Okay, I'm not telling you anything you don't know. And when I say that there's no clarity to the future, you have to kind of go back and have a little bit of a reset for this next week of trade. Like forget what we just saw. Like forget that this has been very low volatility, okay, for the month of September. I'd put that in check. We'll talk about like a little bit of a vol check momentarily here. I'd put in check that we're at all-time highs. What I'd focus on right now is the Fed, okay? So Federal Reserve obviously is having a meeting. That meeting, look, it's largely determined already what's going to happen. If you don't believe me, believe the Fed Fund futures. The Fed Fund futures right now are proclaiming about a 94 to 95% chance of a quarter point cut. That's it. The odds were coming up for a 50 basis point cut, but it's not going to happen. So over and done with. Like, I don't think I need any more explanation than that. Okay, other than to say Jerome Powell during the actual conference, they can be throwing some curveballs, and ultimately, it's going to be his discussion and the Q&A that's going to move markets. And there's quite a bit of volatility actually packed into next week's Fed discussion. But the Fed discussion even takes a back seat, in my opinion, okay, to what's coming in terms of a triple witching. Now, it's not often that I sit here and say, well, triple witching, look, expiration comes every single week in the markets, right? So what's different? What's unique about this, okay, expiration, and why do we call it triple witching? By the way, it's triple witching, it's not quadruple witching. Triple witching means the futures contracts, they expire. Right, so the S&P futures contracts actually expire, got 7 days left. Those are going to be rolled. Then you actually look at major index products like the SPX. The SPX, which has weekly expirations, but we're going to talk about in a moment, is the AM expiration. And then, of course, equity products have an expiration. So there's your triple witch. So why did anybody ever call it quadruple witch? The quadruple witch, the fourth witching, had to do with what they called single stock futures, but that product never really took off. It doesn't really exist now. So it's a triple witch. Okay. Oh, these people talking about quadruple witching. I want to lose it. So you have the Fed back, and I think everybody's focus is on the Fed. But I'm telling you that the triple witch, why is it important? Because it's absolutely massive. So in the SPX, there's an AM settlement. Okay. Once a month, you get these AM settlements. But when you get like the September AM settlement, okay, I have looked at what we term volume and open interest. Let me take volume even off. Okay, let's just look at open interest in here. And what you're actually going to see is effectively we are going to pass through what appears to be possibly, it's right up against it, the single largest options expiration in the history of the business, okay, is upon us. And when you start digging in specifically to this, I'm going to open up all the strikes just to give you a quick glance. When you start to look through it, basically what we're saying is, there's the closing bell. What you basically are looking at here is, look at all these out of the money options, okay? We're talking tens of thousands of contracts. It's trillions of dollars. Just in the SPX, trillions of dollars of notional value, okay, is coming off. Now, this way out of the money stuff doesn't really affect the markets, because the way out of the money stuff, its deltas are basically zero. Like, it doesn't actually impact hedging. What does matter, though, if you look at stuff like these 6500s, holy crap, there's some size trading in here. Look at this. 50,000 here, 56,000 here. You go, oh, it's only 50,000 contracts. First of all, now it's 100,000 contracts. And quite frankly, it's the SPX $6,500 product. Never before, okay, has there been that much notional value, because we're at all-time highs. So 50,000 contracts, okay, now means a hell of a lot more than it meant 2 or 3 years ago when you had a $4,000 SPX, a $6,000 product with this amount, amount and open interest. It's absolutely staggering. The size in here is staggeringly large. So we're going to pass through this expiration, and what's going to happen is they have to either push these contracts further out, okay, roll them, or readjust hedges. And it's going to, if you will, dislocate the marketplace. There is going to be some volatility. In my opinion, though, that's not necessarily coming, like, you don't have to wait till Thursday or Friday. They have to reposition this kind of before the Fed. So there's definitely some volatility in store for next week. Again, don't really take my word for it. I'm pricing a little bit more volatility next week. Again, and I'll come back to that in a moment. Not enough, though, in my opinion. So with that, I wanted to explain, okay, what I see in terms of like why the triple witching is so important. It's just absolutely massive. Now, it's not just in the SPX, okay? Other products in here, okay, your NVIDIAs, your Teslas are carrying just enormous amounts of open interest, okay, in or around where they're presently trading. I am not here to tell you, oh, we're going to 170 or we're going to 185. Expiration doesn't work that way. That Max Payne theory where like you will gravitate to the highest open interest so that's all for nothing. Okay, all I look at, okay, is what I think about is what we term dealer gamma. And the closer you get to the expiration, the larger the gamma. And dealer gamma, it's never been bigger because there's never been greater open interest, okay, in these products, period. I mean, it's staggeringly large open interest. And we're rolling stuff into, like, for instance, NVIDIA and or Tesla. Every one of these tech stocks that you look at, okay, has massive open interest. You want to see something interesting in Tesla? As you open up more strikes, okay, look at how many contracts are out of the money because the stock just ran up, okay, recently. There's tens of thousands of contracts that are out of the money. Nevertheless, okay, we appear to be approaching the biggest expiration cycle, okay, in history, and it's going to dislocate the marketplace. For the most part, when that open interest comes off, hedges come off, okay, and if you will, it just basically means it's letting the dogs out. Things are actually going to get shaken loose because of this expiration cycle. Now, a little bit of a volatility check. One of the things that's literally bothersome to me at this point is how low overall volatility happens to be. But what I hear around kind of a campfire in the industry is that tons of trade is short, okay, in this VX contract, and that's actually suppressing near-term volatility, okay? And, you know, it's been pointed out to me, they're like, look at VVIX. The VVIX came alive earlier this week. Now, this is the volatility of VIX. I was talking about it on Wednesday. The VVIX came alive on Wednesday, kind of faded a little bit, but we're still in that 96 region. People, that's not an extreme reading by any stretch of the imagination. I suppose that this VVIX will take off early next week. Look for the VVIX to take off to the upside early next week, which is going to proclaim there's going to be a lot more movement in the marketplace overall. Again, I'm all about, like, right now, okay, volatility and how the professionals are going to be positioning, because what you see in here is this gigantic expiration coming up, okay? And it just looks like, you know, risk parameters are kind of asleep at the wheel. So if you really want to know if risk is coming, you watch that VVIX early in the week on Monday and Tuesday. If it comes up, duck and cover at that point. Don't look for VIX to necessarily go up. Don't necessarily look for the volatility futures to come up, but that VVIX, okay, would be a stark warning. It did come up. It actually faded a little bit, looking for that to return back to the upside. As I said, Fed's back, triple witching over here. Now, let's talk, okay, kind of the last portion of this, a little bit about what I term as Goldilocks. Okay, there's been a lot of conversation about Goldilocks, and this has a lot to do with overall economic conditions, okay, the markets, and the Fed. So to explain what that Goldilocks condition happens to be, the economy, okay, even though people are mentioning it's weakening, which it may be, still very early on in the data, okay, as data comes out, okay, bad data coming out can actually correspond to moves higher in the market. And think about that, and it blows everybody's mind, but we've all seen it. So you get bad data. Today, for example, we had a consumer confidence number that came out this morning. Okay, I'm not into the consumer confidence number, whatever, but the consumer confidence number came out this morning. You can barely even see it on the screen over here. And the number that came out, okay, was not great. It was a contraction of consumer confidence, and the market initially rallied off of it. Yada, 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 okay? That's a little bit of the Goldilocks scenario. And what it implies is that when bad data comes out, it means Fed to the rescue. The Fed comes in and is going to cut rates, okay? At this point in time, we are definitely seeing, okay, some of that Goldilocks. However, I do believe it's an illusion. Be real careful, okay, in the coming weeks regarding economic data. If it starts slipping a little bit too hard, we're going to go and we're only going to have a quarter point cut next week. So if data is bad after this Fed announcement, okay, the entire marketplace is going to start screaming The Fed is behind the curve, and that's where things are going to get a little bit testy. Okay, look, Goldilocks very well may be an illusion at this point. Bad data may really be bad for markets because the Fed hasn't really begun its next kind of cutting cycle. So again, there's a lot to kind of think about, as I said, but the marketplace last week and this week, okay, it's just chugging along, doing its thing, trading basically on, some of the AI greatness out there. By the way, this is the close today. This is actually technically within the margin of error. It's really not a close outside the expected move. I mean, come on, we just closed at 84, and the weekly expected move is at 67. So it's pretty much within the margin of error. So what do? Close to the upper edge of the expected move, tried for the corner and missed. I mean, it's absolutely been perfect. Okay, spot on over here. So again, a lot to think about in here. And as I said to you, like, I'm not going to sit here and bore you with levels and the volatility box and dropping down to again, the 64.50 level, because we all know that 64.50 level would be interesting, but we're well above it right now. Okay, what's more crucial is the dislocation of a huge amount of options inventory next week is actually going to be, again, cause for concern. Watching volatility early on in the week in the VVIX would actually give us a great tip. Speaking of volatility in the VVIX, last but definitely not least, let's cruise over to the SPX. And the SPX, as I said, closed outside the expected move. We had an $86 expected move all of last week. Next week, okay, volatility is slightly elevated during versus, I should say, this week. So what are we looking at for next week? It's right here. Now, it's not set in stone yet. I wait till about 15 minutes after, but we're looking somewhere right near a $94 expected move. So how does that differ from last week? It's mild. Last week, $86 move. Now we're up to a $94 move, which is exactly why I'm going to say this. I will take the over once again on this. Okay. I said that last week, and what did we do? We closed slightly over the $86 move. This $94 move for next week? No, I'm sorry. I'm going to take the over. I mean, you could easily see, okay, $115, $150 move next week. There's a lot of, again, like pent up aggression when it comes to volatility. It's been suppressed. It's September, okay? This marketplace, this thing is ready to rock. So keep your hands and feet inside of the vehicle pretty much at all times over here. Again, the triple witch is just a $1 trillion wave coming towards you. In fact, multi-trillion-dollar expiration headed at us next week. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.